Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with the 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
So we knew it was going to happen, but today was a day. We saw a little spike in mortgage rates. Like I said, we knew it was going to be happening. The 10-year's been inching its way upward, and we just haven't seen a ton of movement in rates. And today we finally got it, which happened to coincide with some actual, data. We got Case-Shiller home price report and consumer confidence. Busy week, of course, for central banks. That, of course, is happening today with the Fed, and then tomorrow we got Bank of England, ECB. But it's just nice to actually have direct correlation to what's happening in markets and the data that we are seeing. But welcome, everyone, to the Wednesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I'm sick, I'm on vacation, or it's the Azalea Festival. It is neither of those things, so here we are. And we did get, like I said, a consumer confidence report, which somewhat countered, and I mentioned this yesterday, somewhat countered the Michigan report that we got on Friday. And then we also got some Case-Shiller home price data, which, as expected, home price growth continues to slow. Lowest level in about 2 years is sort of where we are. But it was gas prices that was getting all the attention for most of the day. In fact, earlier on Tuesday, the 10-year was up about almost 4 basis points. But it looks like it's going to end the day up just over 1. And a lot of it's what's going on with oil markets. There's no doubt that oil is rising, as it seems like we are at an impasse. But it's always darkest before the dawn. And it does seem like we will be getting closer to a lot of pressure on Iran from a financial standpoint. But we did see a jump in the 30-year fixed. According to Mortgage News Daily, they had their 30-year fixed rate index jumping 6 basis points, hitting a 2-week high. And we knew that was coming because in the last 3 or 4 days, trading days, we've been seeing the 10-year inch up, 1 basis point, 3 basis points, 2 basis points, and really no movement in the 30-year. And then finally we got the jump that we all knew was coming. So up 6 basis points. Once again, according to Mortgage News Daily. But let's talk about gas prices. So that was the story of the day, no doubt about it. And if you've had to fill your car up, then you are obviously well aware of this. But gas prices in the U.S. hit a 4-year high today, according to AAA. And, it's kind of it's funny because gas prices and the relationship to a barrel of oil is very similar to, the 10-year yield and the 30-year fixed, where they do tend to move together in tandem. So they are moving together, but it's not exact. So it's not the 10-year went up 2 basis points, so the 30-year also went up 2 basis points. That is not the relationship. And it's very similar with oil. So you might see oil prices spike and then, by however X percent, and then you see a bigger spike at the pump. And so once again, they're moving in the same direction, but they're not moving necessarily exactly the same way. So the average cost for a gallon of gas was $4.18, according to AAA. The price at the pump has not been this high since April 2012, so over 4 years. That was shortly after Russia invaded Ukraine. The jump was up 1.6%, and it was the highest percentage increase in more than a month. So we had seen some stabilization. But because we haven't heard of any developments, there is this concern, and we've talked about this many a times, about when will these higher oil prices start bleeding into other aspects of the economy. And so that's why you're seeing inflation concerns. And then that's what causes bond yields to rise. So the price of crude oil had risen steadily over the past week as talks have stalled during this sort of unsteady ceasefire. Brent crude, the international benchmark, has posted gains in 6 of the past 7 trading days, according to the New York Times, and remains more than 40% higher than before the Iran war started. So that was sort of the big news this morning. And then we got a bigger development that could actually be, I think it's a good news for consumers of energy because OPEC sucks. And the announcement is that the United Arab Emirates, the UAE, announced that they were leaving the OPEC oil cartel that they have been a part of for decades. And OPEC, as we all know, does, in some cases, when oil prices start to fall, they'll limit production. And I get it. They're doing what's in the best interest of oil-producing countries, hence OPEC. But as, what is it, oil-producing, exporting countries? It's something like that. I think that's what OPEC is. Something along those lines. But what's happened, and once again, this is from the New York Times, they even mentioned this. The organization's power has slipped in recent years as production soared in non-member countries, chiefly the United States. So, and like I said, this is probably good news. I don't see how it can be looked at as being bad news. So, Emirati officials have long floated the idea of quitting the cartel, complaining that quotas had unfairly limited their ability to export, right? Because they're making moves that are in the best interests of sort of the group as a whole. And so some countries that can't produce more, whatever it may be, or have difficulty getting their oil other places, countries that can produce more and can get their oil out there are sort of limited by the partnership. And so the UAE saying, all right, we're out. They can now do what they want to do. And, it's been said they want to get their capacity up to 5 million barrels a day, which would be good because in case you haven't looked at overall energy usage, it's on the climb. So this would not be a bad thing. Emirati officials decided to leave OPEC so they would have more freedom to meet consumer demand. The country's energy minister, Suhail al-Mazrahi, said in an interview with the New York Times. The announcement came amid festering tensions between the Emirates and Saudi Arabia, who is the de facto leader of OPEC. And the war with Iran actually just made things worse. So the Emiratis had suffered thousands of Iranian missile and drone attacks. Emirati officials have spoken for their dissatisfaction with the response of regional multilateral organizations, including the Gulf Cooperation Council and the Arab League, hinting that they would have preferred a harsher unified stance against Iran. Now, the UAE is not the first person to leave OPEC. For example, Angola, Ecuador, and Qatar, or is it Qatar? I think it's Qatar. They left the cartel in 24, 20, and 19. But the UAE is the biggest producer by far. Makes this much more consequential. And Abu Dhabi, now the capital of UAE, joined OPEC in 1967. So they've been a member for a while. It's like Maryland leaving the ACC. No, I'm just kidding. It's not. No, because Maryland Maryland was a founding member of the ACC, but it didn't really have a huge impact on the ACC. However, that would be like UNC leaving the ACC. It would probably lead to the demise of the ACC. And that could be the end of really OPEC. I'm sure there'll be some, it'll stay around, but the impact that it used to have is clearly going to be gone. And so that was all happening. And then, just to keep with the gas topic, Wall Street Journal had a great piece about Iran. So I've said this, and we'll continue to say this, that the best move the U.S. made with regards to pressuring Iran to make some deal to end this war has been the double blockade. So, of course, originally Iran said they're going to block the Strait of Hormuz, but they were still allowing their ships to leave. And the U.S. said, no. If we're going to do a blockade, we're going to do a blockade, and your ships can't leave. And that has significantly impacted Iran because they now can't get the oil out. Now, their economy is already in shambles thanks to the 12 days war. That was already a problem for them. And like I said, that was causing massive inflation, just overall problems, economic unrest. And then this happens. And now they can't get the oil out, and it's hundreds of millions of dollars a day in economic output that they are losing. I think it's around $100 million, something like that, just in oil. But the sort of impact that has on the economy is hundreds of millions of dollars. And so what's happening is Iran's still producing the oil. So they're storing it, but they're running out of storage. And so they're having to use derelict tanks, basically places they don't want to store the oil for whatever reason. And they're having to use that. And eventually they're going to run out of that too. Now they're trying to get oil to China using rail, but it's just not going to be anywhere near as effective as sea. And so they're going to get to the point. We don't know what it is. We've heard 2 weeks, I think, is the argument. Then they'll run out of storage space and then they'll have to shut down the pumps. And that is huge. That could be billions of dollars, because it's not just like you turn a switch and flip everything off. I mean, it's shutting down this massive sort of infrastructure that leaving it idle, which it was not supposed to, it's not supposed to happen, could be very, very problematic. In fact, it's mentioned in the piece. Let me see if I can find it real quick here. Somewhere here. Here it is. Shutting production abruptly can damage older oil fields, especially those with low pressure or a fragile geology. Around half of Iran's oil fields have low pressure, leaving them vulnerable to long-term production losses after stoppage. This according to consulting firm Rystad Energy. To be sure, not every production stoppage destroys a well, and Iranian engineers have experience managing production under the sanctions. But Iran's old equipment and mature fields make forced production cuts particularly risky, according to Iranian officials. So, big changes for oil markets is what we got going on right now. So we got prices that are jumping, no doubt about that. And a lot of that is because Iran can't get its oil out. It's, at one point it was 2 million barrels a day it was shipping, and now I think it's under 500,000. So that's obviously going to impact global markets, pushing the price up. Less supply, same demand equals higher prices. But we got the UAE who's like, you know what? We're going to start trying to pump out some oil, and we don't care. They're leaving May 1st, so they're out of there very soon. What is it? Is that this weekend? When is the first? Because I think the Derby's the 2nd, so that's Saturday. So let me see. Friday. They're out of there on Friday. And so it's not going to happen overnight, but clearly Iran not being able to get the oil out there is hurting their economy. And then what's happening is people are finding new sources to get oil from. And then all of a sudden, they don't need Iran anymore. They're not going to go back. So Iran definitely doesn't want to shut down and lose its trading partners. No doubt about that. All right. Okay. That went way longer than I thought it was going to go. Let's talk about consumer confidence. So we had the University of Michigan report that came out on Friday that was not good. 70-year low, if my memory serves me correct. And so you would expect, and we were expecting, a drop in consumer confidence. It, however, did not happen. In fact, consumer confidence actually ticked higher in April, defying expectations. The Conference Board's Consumer Confidence Index rose 0.6 points, so not a big jump by any stretch of the imagination, to 92.8, but that is the highest reading since October. And economists were actually expecting it to drop below 90. So better than expected, or a lot better than expected, I should say. The improvement was modest. The present situation index actually slipped slightly to 123.8, while the expectations index rose to 72.2. So people felt a little better about the economy going forward. Young consumers are driving the gains on a 6-month average. Confidence improved among millennials and Gen Z, while older Americans grew more pessimistic, as older Americans tend to do. Income trends were mixed, with most groups showing less optimism overall, and political affiliation, not surprisingly, Republicans remained the most optimistic, while independents and Democrats declined among independents, and actually a slight uptick for Democrats. Kind of surprising. Dana Peterson said, economist from the Conference Board, said the overall trends remain flat, saying consumer confidence edged up in April, but was little changed. So a little surprising that we did see an uptick. But, 6-month high is a 6-month high, any way you look at it. But here's what's interesting. So there was a piece today in the Wall Street Journal by Rachel Wolf in which she was talking about what's essentially happening and why you're seeing sort of spending, while you're not seeing a huge impact on inflation. They were looking at the Bureau of Economic Analysis, looking at the data and looking at the certain sectors of consumer purchases. And what they found is that the sectors of the economy that are getting hit the hardest by inflationary pressures, whether it's tariffs or whatever it may be, is where you're seeing spending slow down. And so what's happening is consumers are shifting spending. So areas where prices are jumping, they're pulling back, but they're then shifting spending to places where inflation isn't so bad. So for example, spending on clothing fell about 7% between December and the end of February, inflation adjusted and seasonal variations and, adjusted as well. Clothing prices were up 9% over that same period. And if you use that same methodology and time frame, furniture buying was down 5%, prices were up 7%. Sporting equipment purchases were down 6%, prices were up 16%. Wolf notes the dynamic is important because it reveals a weakness not evident in the broader data. Consumers are pulling back where price increases on goods are most dramatic, and consumer spending in the aggregate appears to be holding up, a sign that some say shows inflation isn't having that much of an effect despite widespread complaining. But under the surface, inflation's impact is clear. People are spending less on products where you are seeing inflation rise. They're just then using, if they have extra money, so they're not going to buy that shirt or that suit or that dress or whatever, but then they may go on a trip or they may go spend it somewhere else. And so it is having an impact, just not, as they say, on the aggregate. It's happening in the certain sectors that are being impacted by the economy, or by inflation, I should say. So very interesting. That's from Rachel Wolf. And then before we go, I'm a little bit over my time. Home price growth, not surprisingly, slowing in the latest Case-Shiller report looking at the month of February. We had home price growth up just 0.7% year over year. It's not month over month. That's year over year, 0.7%, down from 0.8% in January. That is the weakest level since July 2023. Inflation continues to outpace home price growth, which is a problem, no doubt about it, because, let's face it, rates are at 6.5%, so you're borrowing money to buy something. You would like to see the money that you're borrowing outpace whatever your, mortgage rate is. And that's not happening. It's not even happening with inflation overall. And so that becomes a bigger issue to people than, pull back, not buy. We're already seeing we had seen kind of a stall in the spring because of rates jumping up a little bit. Performances did vary widely. Chicago led the 20-city index with a 5% annual gain, followed by New York, 4.7%, and Cleveland at 4.2%. And then Denver, I think, stole the bottom spot from Tampa with prices lagging down 2.2% year over year. More than half of the major U.S. metro areas posted annual price declines, according to Nicholas Goddick at the S&P Dow Jones indices. So it's not just limited to, say, like the Sun Belt market. And, what's kind of funny, though, is that this is what happens when you get kind of a heated housing market, is that you then see a pullback. And what you see is a slowdown. And then we could potentially have, negative year over year numbers. But not a crash. It's funny. I thought we had beaten some of these doomers and gloomers, these people out there that have been calling for a housing crash since 2020. So like 6 years they've been calling for, and they got a little quiet this year. And I've seen them kind of pop back up recently. with the dumb charts and everything. Oh, look how much prices have gone up. So, of course, that means, just so everyone understands, there is no economic theory that says what goes up must come down. I know we all think that. Like, I get it, it's a saying, but it's not an economic theory. Just because prices go up, they do not have to come down. In fact, for the most part, most prices that go up do not come down. That's why people get so upset about inflation, because inflation is not followed by deflation. A lot of times the prices are then stuck there. And so people are just obsessed with this idea. Oh my gosh, home prices have jumped so much, so they have to crash. No, what happens is you just see kind of a slowdown in price appreciation. And then what will happen is that people will then list their house for less. Someone will buy it for a little bit cheaper, and then they'll get some price appreciation because they bought it for a deal. So then you will get price appreciation. It's the way the beautiful economies work. That's how things work. But all right, it was a busy show. And then today we got a lot to get to. We're talking about on Thursday's show. We got housing starts. We got building permits. We got durable goods orders. And then, of course, the big one, not so much the Fed rate decision. Likely they're going to hold rates unless something crazy happens. But Powell's last press conference as Fed chair. Very sad. No, it's bittersweet, I will say. So definitely be watching it, talking about it on tomorrow's show. But wow, this is a long show. Over 20 minutes. You guys, I've taken up enough of your time. I will see you guys tomorrow. You guys enjoy your Wednesday. And remember, as always, do not wait to buy real estate. You buy real estate and wait.